What happens between your investment and your monthly interest credit? Your monthly interest does not just appear in your bank account, it follows a complete tax journey. From TDS deductions and PAN verification to tax regimes, refunds, and income tax return filing, every step matters in determining your final tax position. In the next few minutes, we'll simplify the intermediate level tax structure of GHL India Asset Secured NCDs, helping you understand how your interest income is taxed, how TDS works, and what you need to know for tax compliance. Let's dive in. One. How is NCD interest taxed for senior citizens and lower tax bracket investors? The taxation of interest earned on GHL India secured NCDs depends on the individual investor's taxable income, not on age alone. Whether an investor is a senior citizen or falls in a lower income tax bracket, the interest received from the secured NCD is taxable according to the applicable provisions of the Income Tax Act. Does being a senior citizen mean the interest is tax-free? No, being a senior citizen does not automatically exempt the interest income from tax. However, many senior citizens may have lower overall taxable income, basic exemption benefits subject to the applicable tax regime, eligibility for certain deductions under the Income Tax Act. As a result, their effective tax liability may be lower than that of a high-income investor. How does this work? Example 1. Senior citizen with lower taxable income. Suppose annual interest from NCD is 2,40,000 rupees. Total taxable income falls within a lower tax slab. Although 10% TDS will be deducted under Section 393 of the Income Tax Act 2026, the investor's final tax liability may be lower. After filing the income tax return, the investor may become eligible to claim a refund of excess TDS if applicable. Example 2. Investor in a higher tax slab. If another investor receives the same interest but falls in the 30% tax bracket, the final tax liability may be higher than the TDS deducted, and additional tax may be payable while filing the return. Key principle: TDS and income tax are two different concepts. TDS is a mechanism for collecting tax in advance. Final tax liability depends on the investor's total taxable income and the applicable tax provisions. What should senior citizens do? We recommend that investors review their annual taxable income, check the applicable tax regime, verify TDS reflected in Form 26AS AIS, consult their chartered accountant or tax advisor for personalized advice. Important clarification: senior citizens do not automatically get tax-free NCD interest. The final tax depends on their total taxable income, while the 10% TDS is only an advance tax deduction. Even if 10% TDS is deducted, investors in lower tax brackets may be eligible to claim a refund, while investors in higher tax brackets may have additional tax to pay. The final liability depends on each investor's individual tax position. Your age does not determine your tax liability. Your taxable income does. 2. Does choosing the old tax regime or new tax regime affect the taxation of NCD interest? Yes, the tax regime selected by an investor can influence the overall tax payable on interest earned from secured NCDs. However, the nature of the income does not change. Interest earned from secured NCDs continues to be taxable as income from other sources under both the old tax regime and the new tax regime. The difference lies in how the investor's total taxable income is computed, as each regime has different tax rates, exemptions, and deductions. Does the tax regime change the TDS deduction? No. The applicable 10% TDS under Section 393 of the Income Tax Act 2026, subject to applicable law, is deducted irrespective of whether an investor has opted for the old tax regime or the new tax regime. The chosen tax regime affects the final tax liability, not the TDS deduction at source. How does the tax regime affect investors? Old tax regime. Investors may be eligible to claim certain deductions and exemptions available under the Income Tax Act, subject to their eligibility. As a result, their taxable income may reduce, thereby reducing the final tax payable. New tax regime. The new tax regime generally provides concessional tax rates, but with fewer deductions and exemptions. For some investors, this may result in a lower tax liability, while for others, the old tax regime may be more beneficial. Example: suppose two investors each receive annual NCD interest 2,40,000 rupees. Investor A chooses the old tax regime and is eligible for several deductions. Investor B chooses the new tax regime and does not claim those deductions. Although both receive the same interest income, and the same TDS is deducted. Their final tax liability may differ depending on their overall taxable income and the regime selected. Should investors change their tax regime because of NCD interest? Not necessarily. The choice between the old and new tax regime should be based on the investor's overall financial and tax position, including salary or business income, other investments, eligible deductions, total taxable income, long-term financial planning. NCD interest should be considered as one component of that evaluation. Important clarification. The tax regime affects your overall tax liability, not the nature of the interest earned from the secured NCD. Whether you choose the old or new tax regime, interest from secured NCDs remains taxable. The tax regime influences your overall tax liability, while TDS is deducted as per the applicable provisions. Choose your tax regime based on your overall financial profile, not on a single investment. 3. What happens if PAN is not provided? Providing a valid permanent account number, PAN, is mandatory for smooth tax compliance and investor reporting. PAN enables GHL India Asset to deduct TDS at the applicable rate. Deposit the TDS with the Income Tax Department. Report the deduction against the investor's PAN. Ensure that the investor receives credit for the tax deducted while filing the income tax return. Why is PAN important? A valid PAN helps ensure accurate TDS deduction, proper tax reporting, reflection of TDS in Form 26 AS and AIS, seamless claim of tax credit. Providing PAN is therefore mandatory for the investors. What happens if PAN is not furnished? As per the current provisions of the Income Tax Act, if an investor does not furnish a valid PAN, TDS is generally deducted at 20% instead of the normal 10% on interest paid on debentures, subject to the applicable provisions of the Income Tax Act. For example, if the monthly interest is 50,000, then 10% TDS, which amounts to 5,000 rupees, will be deducted if PAN is provided. If PAN is not provided, then 20% TDS, which amounts to 10,000 rupees, will be deducted. This means the investor will receive a lower net interest amount. When PAN is not provided, can the investor still claim tax credit? Yes, if the applicable tax requirements are subsequently complied with and the TDS is properly reflected in the investor's tax records. The investor may claim credit while filing the income tax return, subject to the provisions of the Income Tax Act. However, furnishing PAN at the time of investment helps avoid unnecessary complications. GHL's investor onboarding process. To ensure smooth investment processing, GHL requests every investor to submit PAN, Aadhaar, bank account details, other KYC documents. This helps ensure accurate TDS deduction, statutory compliance, and timely tax reporting. Important clarification. Providing your PAN ensures that the correct TDS is deducted and that your tax credit is seamlessly available when filing your income tax return. Always provide your PAN while investing. Under the current tax provisions, TDS on debenture interest is generally 10% with PAN, but may increase to 20% if PAN is not furnished. Submitting your PAN helps ensure proper tax credit and higher net monthly payouts. A simple PAN submission today can prevent higher TDS deductions and ensure hassle-free tax compliance tomorrow. Tax laws are subject to amendment from time to time. The TDS rates and tax treatment described here are based on the applicable provisions in force at the time of publication. Investors are advised to refer to the latest legal provisions or consult their tax advisors before making investment decisions. 4. Can TDS deducted be refunded by the Income Tax Department? Yes. TDS deducted on the monthly interest of secured NCDs is not a final tax. If the TDS deducted exceeds an investor's actual income tax liability, the excess amount may be claimed as a refund by filing the income tax return, ITR, subject to the applicable provisions of the Income Tax Act. In simple terms, TDS is an advance collection of tax by the government, not an additional charge imposed by GHL India Asset. How does it work? When GHL pays monthly interest, interest is credited to the investor. TDS is deducted at the applicable rate. The deducted TDS is deposited with the Income Tax Department against the investor's PAN. The investor can later claim this TDS as tax credit while filing the income tax return. Example 1. Eligible for refund. Suppose an investor receives annual interest income 2 lakh rupees. TDS deducted at 10% 20,000 rupees. After considering the investor's total income, deductions, and applicable tax regime, the final tax liability is only 8,000 rupees, since 20,000 rupees has already been deducted. Total TDS deducted 20,000 rupees. Final tax liability 8,000 rupees. Refund eligible 12,000 rupees. The income tax department may process the refund after the income tax return is filed and verified, subject to applicable provisions. Example 2. Additional tax payable. Suppose another investor falls in the 30% tax bracket receives annual interest income 2 lakh rupees. TDS deducted 20,000 rupees. After considering the investor's total income, deductions, and applicable tax regime, the final tax liability is 60,000 rupees. Since 20,000 rupees has already been deducted, total TDS deducted 20,000 rupees. Final tax liability 60,000 rupees. Balance tax payable 40,000 rupees. The investor should pay the balance tax 40,000 rupees to adjust against final tax liability. When can investors claim the refund? Generally after TDS has been deposited by the issuer. TDS is reflected in Form 26AS AIS. The investor files the income tax return. The return is processed by the income tax department. What documents help in claiming the refund? Investors should retain Form 16CA where applicable. Form 26AS. Annual information statements AIs. Interest payment statements. Income tax return acknowledgement. These documents help reconcile tax credits and facilitate refund claims. Important clarification. TDS is not an expense. It is a tax credit that can either reduce your tax liability or become eligible for a refund. Don't think of TDS as a loss. It's an advance tax deposit against your PIN. If your actual tax liability is lower, you can claim a refund by filing your income tax return. TDS is money credited to your tax account, not money lost. Refund of TDS is subject to the investor filing a valid income tax return, the TDS being correctly deposited and reflected in the investor's tax records, and the provisions of the Income Tax Act as applicable from time to time. 5. How should NCD interest income be reported in the income tax return (ITR)? Interest earned from GHL India's secured NCDs should generally be reported by the investor under the head Income from Other Sources while filing the income tax return (ITR), unless a different treatment is specifically applicable under the Income Tax Act based on the investor's circumstances. The investor should disclose the gross interest income before TDS's deduction, not merely the net amount credited to the bank account. Why should gross interest be reported? Many investors mistakenly believe that only the amount received after TDS should be disclosed. This is incorrect. For income tax purposes, gross interest earned taxable income, TDS deducted a tax credit. The TDS is separately claimed as credit while filing the return. Example, suppose gross monthly interest 50,000, TDS at 10% 5,000 rupees, net amount received 45,000 rupees while filing the income tax return. Interest income to be reported 50,000 rupees, TDS credit to be claimed 5,000 rupees. This ensures proper computation of taxable income and tax credit. Which documents should investors refer to? Before filing the income tax return, investors should reconcile the interest income with Form 26AS, Annual Information Statement AAS, Form 660AS where applicable. This helps ensure that both the income and the TDS credit are correctly reported. Why is accurate reporting important? Correct reporting helps avoid notices from the income tax department, ensure proper tax credit, prevent mismatch between reported income and tax records, facilitate smooth processing of the income tax return. Important clarification. Always report the gross interest income and separately claim the TDS credit. This ensures accurate tax reporting and avoids reconciliation issues. Do not report only the amount credited to your bank account. Report the gross interest income in your income tax return and claim the TDS separately as tax credit. Report your income correctly, claim your TDS correctly, and your tax compliance becomes effortless. The manner of reporting income may vary depending on the applicable income tax return form, the investor's status, and changes in tax laws. Investors should consult their chartered accountant or tax advisor for guidance specific to their circumstances. With the intermediate concepts now behind us, you've gained a solid understanding of how GHL India asset secured NCDs are taxed. In the next episode, we'll move into advanced tax provisions, including advanced tax on NCD interest, taxation of HUFs, companies, LLPs and trusts, joint investment taxation, the impact of changes in tax laws during the investment period, and the tax checks investors should do before investing. Join us as we simplify these advanced concepts and complete the bigger picture of NCD taxation. See you in the next episode.